Hello again. Thank you so much for watching. Today we will be discussing the very best places to market as a commercial real estate loan broker and why this map is key if you are trying to market up business, originate business in the United States. So let's jump right into it. Oh, before we get started, please don't forget to hit the subscribe button as well as the notification bell. It helps our YouTube algorithms, and don't forget to like our videos. And also, if you haven't checked out our Patreon yet, you definitely should, especially if you're a commercial real estate loan broker. A lot of useful information. A lot of our brokers draw a lot of great value out of this. So let's jump right into it. So where are the very best places to originate business? Where should we market as commercial real estate loan brokers? Well, it's very simple. There's two places. The place number one is where the quick and easy deals are and where the biggest commissions are. So the quicker the deal, the easier the deal, the more deals you'll be able to push out. And then also you want to make sure if you are doing business, you're not banking in small commissions. You want to make sure you're banking in big commissions. So we're going to dive into each one of these points, what those deals look like. So let's just jump into it. So what is a quick and easy deal? Well, first off, you got to have quick and easy borrowers. So there's two aspects to every deal. There's the borrower. So you want to have a borrower that's very easy to work with. And then there's the property. What does the property look like? So there's two aspects here. So we're going to look at each one of these aspects so you can know who to identify that's a good borrower, a good property, and who you should avoid as borrowers, and what type of property you should avoid. So what's a quick and easy borrower look like? Well, let's look at what to find and what to avoid. Number one, they should be an investor that is experienced, somebody that has one or two, maybe three properties under the belt. The more experience, the easier the borrower to work with. The less experience, the harder it's going to be to do a loan with this person. That's not only because the lenders don't want to lend to inexperienced investors, but it's also because the borrower just doesn't understand the process. So they're going to be slower in getting you documentation, most likely, and they're going to have a lot more questions, and it's going to take you a lot longer to do their deal. Also, a quick and easy borrower is going to be someone who's well capitalized, someone who has enough money to make the deal happen, and they're not penny pinching the deal. On the other side of the spectrum, of course, we want to avoid those who are undercapitalized. So these are borrowers who just don't quite have enough money to make the deal work, whether that they're missing out on their down payment, or maybe they do have the down payment, but they don't have enough for the closing costs. So again, this is somebody who's undercapitalized, going to make it a harder deal for you to even make a living off of. And then finally, we want to find someone who is serious. So a serious borrower is typically someone who's put in who signed a purchase contract. So they've already got the deal moving and they need a lender fast to make the deal work. On the other end of the spectrum, we want to avoid the shoppers, those investors who, these are typically going to be your inexperienced investors, actually, who are shopping around, and they haven't put in an offer in a house yet, and they're just kind of shopping, trying to find the best rates. You want to avoid these types of borrowers at all costs, especially in the industry that we're in, where we're not selling on rate, we're selling on convenience, and we're selling on ease of underwriting. Those are the types of deals we are normally doing. So we want to see an experienced investor, someone who's well capitalized and who's serious. If someone hits any of these three on the right-hand side, you want to avoid them at all costs. Inexperienced, undercapitalized, and if they're shopping around, just hang up the phone. On to the next section. So what makes it a quick and easy deal? You got your properties, right? We went through what a borrower should look like. So now we need to look at what a property should look like. So what are we looking for and what are we trying to avoid? Well, the very first thing is we want to look for existing structures. So these are deals where there's a structure that's already built. The land is already flattened. The structure is built, and it's more of a vanilla property. So if you're not familiar with the term vanilla, all that basically means is when you open the doors, you can see drywall hung up, and it's ready to be moved in. On the other end of the spectrum, we want to avoid those deals that are ground up construction, the deals that have that rehab component. There is a lot of business in fix and flip financing. I I will not discount that point. However, when you get a deal that's ground up construction where there's a borrower trying to buy some land and then they need to do all the licensing and all the permits to get the land built, that's just a deal that's going to take way too long, and you want to avoid it at all costs. Those ground up construction deals take too long and there's too many components. So I recommend you always work on existing structures. Even if it has rehab, an existing structure is what you're looking for. The second type of property you want is a standard use property. So a property that can be used by generally any kind of business owner. Now, this isn't talking 1 to 4 investment properties. This is talking commercial real estate. So if you see a deal, for example, and it's a bowling alley, well, the only type of tenant that can occupy a bowling alley is a bowling alley owner. And how many of those people exist in the United States? Not very many. So that's what I call a special use property. There's also institutional buildings such as schools and churches. These are very special use buildings, and they're very difficult deals to get done. So what you want to do is you want to try to focus on those standard use buildings, those buildings that are good for general use, like office space, warehouse, even auto businesses. There's several different kinds of businesses that can go into an auto repair or like a tire shop, something like that. So we want to see the standard use buildings that anybody can move into. It just makes the deal much easier, better. It's easier to find the lenders for those deals. Now, one more thing you want to look for to get a deal done that's quick and easy is a property that's located in metropolitan areas. So in essence, we're looking for high population. The higher the population, the more activity that's going on in the market. So when there's more activity, it breeds more confidence in a lender in that area. On the other end of the spectrum, when you get a deal that's rural, it's very hard to get that deal done because there's not much confidence in rural markets most of the time because there's not very many sales comps. So when there's no sales comps, how is a lender supposed to gauge what the value of the property truly is, aside from what somebody's willing to pay for it? We want to see data. And in rural areas, there just isn't enough data, and it makes the deal slow moving, and it makes it more difficult to bring a lender to the table. So these are the types of properties you want to look into: those existing structures, standard use, high population, and avoid those special use land deals that are in rural areas. Now let's look at big commission. So how am I going to get the biggest commission out of deals? Well, let's jump into it. Who do we want to look for, and what do we want to avoid? Well, number one, we want to look for deals that aren't small. The smaller the deal, the smaller the commission, right? So we want to avoid those $25,000 to $75,000 deals. Most lenders don't lend under $75,000. So if you get someone asking for just 25 to 50,000, it might be a good idea just to walk away. It's going to take you too much time to find someone who does that kind of deal. And then on another aspect is you get paid on commission, right? So you want to get a bigger deal. So a lot of my brokers don't even look at deals that are less than $250,000 deals. So I recommend that you try to make sure you're focusing on over $250,000 deals, all the way up to about 10 million. When you go beyond 10 million, you start to fall into that ground up construction territory, or even just pipe dreams, just deals that take a long time. They're too complex to close, and it's just not very quick and easy deals. So you can still get big commissions off of deals that are between $250,000 to $10 million. You also want to focus on those high value markets. So there are markets across the United States. There are low value markets and high value markets. A low value market's typically going to be somewhere in the Midwest, like Ohio, Michigan. These are low value markets. But when you go on the coastal regions, you're going to see those high value markets like San Francisco, San Diego, New York, very high value markets. So if you avoid the low value markets, what you're doing is you're avoiding low commissions. If you focus on high value markets, you're focused on big commissions. So these are just the places you're going to market. So let's just conclude here, and we'll go over that map that I presented at the beginning, just to kind of wrap things up here. So anyways, what do we say in the beginning? The best deals are found where commissions are big, where commissions are big and the deals are easy, right? So where are commissions big? They're going to be bigger in those markets that are more active. The properties in metro areas, those are going to be easier properties to do. And then borrowers have to be more experienced. They're more serious. They're easier to work with. And then finally, what does this look like? This is when I was going to jump into this map here that we created. And this is what I use. So let's look at it. So what this map is it's the fastest rising real estate prices. And this was taken in 2018. It goes over the last 5 years from 2018 back. I know it's 2021, but this is still indicative of what it looks like today. So see this red area that I circled here? This is where you want to avoid. So this is that Midwest states, mostly rural states, and they're going to these states are typically going to cause you problems either from high crime, or they're going to cause you problems in rurality, or just the low values. And you're going to give you low commissions. If you go into a low value state, you're often going to get very inexperienced borrowers who move into those states, because inexperienced borrowers are looking for less risk because they're not very familiar. And so they'll find they like to look for those lower value deals, those $25,000 to $75,000 deals. So it's going to cause you a lot of problems if you focus in this area, because you're going to be dealing with inexperienced investors, and you're going to getting smaller commissions because they're smaller deals. Now, there's a second little area, this little pocket that sits up top. You got Minnesota up there, and you got Wisconsin, and then underneath you have Nevada, and some of Texas, Colorado. You got some good business. So these are places that you should definitely consider marketing. Why not? You can tell there's a few really big cities in there that are growing very fast. When you have growing cities, growing population, you have growing real estate prices. And when real estate prices are growing, that means you have experienced investors moving into those areas, and the values are going up, and that's going to allow your commissions to go up. So you're going to have more business in these places where real estate prices are going up, because there's more demand in those areas, more real estate investors. And now finally, there's the gold, the pipeline, I like to call it. This is where the money is, and this is on the coast. So on the coast, you're going to see bigger deals. As you can see, real estate prices are higher here than anywhere in the United States on the coastal regions. You're going to find more experienced investors, because investors go where the money is. If you invest in a property in San Francisco, it's going to appreciate in value much quicker than anywhere else in the United States, right? So you're going to get those experienced investors who know what they're doing. And then finally, the quality properties, the properties that lenders like to lend on. They're going to be in high population areas. So there's a lot of data on them, and there's more confidence in the area because of the appreciation, right? So anyways, use this map. If you haven't already done so, if you live in one of these these Midwest states, I'm sorry, I recommend that you do push out your marketing and try to focus on the coast. In what we do, we can work nationwide. So why should you stick just to the local environment when you can push all the way out to the rest of the United States? If you do live somewhere else in one of your coastal cities, congratulations, you're in the money zone. So just get on the streets and start drumming up business, because that's where it's at. So anyways, use this map. I highly recommend it. This is the map I use. I always recommend to my brokers. This is where you're going to make the most money. Know what to avoid, and know where to focus your efforts when you're originating business. Thank you so much for watching. And if you haven't already done so, please hit the subscribe button and the notification bell. Like this video if it helped you out. And then also, if you haven't checked our Patreon out, we have a ton of free content on there, as well as exclusive content that you don't normally see here on YouTube. And it helps a lot of our commercial real estate brokers get to the next level. So thank you so much for watching, and we'll see you on the next video.